Hello and welcome to The Context. I'm Nivedita Varadarajan. Today I have with me CRISIL's principal economist Dipti Deshpande, and we're going to discuss the state of the Indian economy. Thanks a lot and welcome to the program, Dipti.
Thank you, Nivedita, for having me here.
So let's start with something which grabbed national headlines. The prices of potatoes, onions, and tomatoes and other vegetables increased a lot. Why is the inflation for food? Why did it soar so much?
I think a lot has to do with the interim supply disruption related issues on and off that certain regions have been facing because of either lockdowns or restrictions overall over the last 1.5 years. But overall, if you go to see, it is in fact food inflation, and it's in fact inflation in vegetables along with cereals that has been bringing about a lot of respite in food inflation in recent months. On a broad scale, I think there is more comfort than worry in terms of food inflation when you really go to look at it.
So, other than supply side issues, are there anything else which are affecting the prices?
Uh, at the moment, not really, but there were unseasonal rains, and typically we know that vegetables are an extremely volatile component of inflation. So when you do have these sporadic rains in certain parts, it's been affecting supplies for a short period of time. But like I mentioned earlier, if you look at it on a broad trend basis, a year back it was inflation in vegetables which was actually causing a lot of trouble, but in recent months it's been this particular category which has led to a lot of comfort, in fact.
So, the RBI actually cut the forecast for inflation this year from 5.7% to 5.3%. Is there a discrepancy between the RBI's data and its forecast and the ground realities, seeing that there'll be so many uncertainties which are happening?
Yeah, not really. I think, in fact, we too recently brought down our inflation forecast. It was earlier at about 5.8%. We brought it down to 5.5 because there have been some very positive surprises on the food inflation front. The number one factor which is benefiting inflation, helping it come down, is an extremely high base. Inflation last year was very high, so that's a natural statistical effect that is coming into play. The other is we've had successive good crop seasons, be it starting from the previous rabi to last kharif to this kharif. In fact, groundwater looks good for the upcoming rabi as well. So broadly, if you go to see, these two factors are really at play. So they can bring down inflation statistically to quite an extent, even in the coming months. In fact, if you look at, like, to reiterate, if you look at the key categories that matter, which is cereals or vegetables, these are the ones where we are in fact even seeing a sequential decline. So the point being that that's where inflation could continue to come down, and I think RBI is taking that into consideration. Food inflation is, after all, 40% of the CPI basket. The risk, however, remains on the non-food inflation front, and I think that is where they have also sufficiently provided a caveat in terms of what kind of upsides could be possible.
Can you tell us what are the components in the CPI basket and what's their weightage?
So broadly, like I said, food inflation is about 40%. If you look at fuel, it has a relatively lower weightage in the CPI basket compared to WPI, and that's around 15% or so. And the rest is what we usually call as core. So I think when the RBI looks at inflation and it wants to take some action basis inflation, while it does look at food inflation and fuel, it has a very keen eye on what's happening in terms of core inflation, because core inflation is something that's difficult to bring down once it starts picking up. For the sake of listeners, core inflation is typically that part of inflation which goes up and demand in the economy starts rising and supply is unable to catch up. So
So,
that
what are in this core? What are these core inflation? What is in this component?
So core inflation component typically would include transportation costs, it includes health, education, it includes household items. Services components of CPI is also included here, which is recreation, entertainment, community services, all of those. So I think that's where we are seeing high inflation around 6%. But a large part of that is not coming in because demand is rising. It's in fact coming in because of supply related issues. It's coming in because manufacturers are, for instance, passing on higher input costs. So the worry angle is not so much yet because it's supply rate. But towards the end of the fiscal, when demand starts picking up and income strengthens, that's when the RBI would want to look at this part of inflation with a lot more focus.
So I want to talk a little bit about the inflation in food and fuel before we go on to core inflation.
Yes.
Um, a recent report says that the demand in rural areas for FMCG goods has dropped. It is now 1.5% in the September quarter, according to the report, compared to 4.5% by volume last year. Is the high inflation a reason for this?
It could be one of the reasons for it, because when you look at the rural urban split of consumer price inflation, while on average an average Indian consumer spends about 40% of his basket on spending basket on food, a rural consumer spends a little more than that. So naturally, in the last 1.5 years, up until say Feb or March, because food inflation was so high and it was high in commodities like cereals, pulses, vegetables, which are core consumption categories, there would have had been some impact. But I think the other bigger impact is also because of the hit to incomes. One, because of lockdown restrictions, etc. The second is also the kind of support that the rural areas, the kind of income support that they received last year from policy in terms of lot more spending on Narega, rural construction works, etc., did not happen or has not happened so far this fiscal. So the rural areas broadly, their resilience to brace the crisis is somewhat lesser this year compared to the last. So that might have been a couple of reasons why demand looks a little softer there.
So, inflation is also affecting the urban poor. They are also feeling the heat.
Yes.
The prices of fuel and food has soared, and this is affecting the poor. A survey by CRISIL itself is saying that. So, how will both this low demand from the rural sector, rural population, and the poor in the urban areas affect the economy?
Yeah, so yeah, of course, definitely. I think we did a study recently. In fact, we looked at consumption baskets based upon how it's available in the NSSO reports. We split them by income classes, and I think the biggest finding that came out of the report is that if you look at the urban poor, or lowest 20% of those residing in the urban areas, those are the ones that have seen inflation in the range of about 5.6 to 5.7% on average in FY21 and even so far in FY22. Now the reason for that again being the same thing, food has a higher share in for consumption in this consumption basket, so also fuel, where prices are going up. So I think broadly that is impinging to some extent on their ability to consume, but it's happening more so because incomes are slow to go by. So as vaccination progresses, as inflation on the food front softens further on into the year, I think some pickup should happen in terms of economic recovery. But I think one of the points that we've been stating quite frequently is the fact that the revival in consumption is unlikely to be as rapid as it has been when each of the last few times that India saw a slowdown.
So, what can the government do to ensure that it comes the rural poor and the urban poor spend more because they don't have money in their hands? What can the government do?
Uh, Two, three things really. I think one is that all of this price rise that we are talking about, a large part of it isn't quite in the hands of the government. Be it what's happening on the food side or in fact what is happening on the fuel side, coal, gas, and number of other things. What the government has done is given the fact that there is a stretch on the fiscal finances. In fact, I'd say the consumer is bearing a bigger brunt of these exogenous factors this time around than it has in the past. We have seen that fuel taxes have gone up. We've seen that subsidies on fuel have come down to the minimum. Oil prices have gone up. So point essentially mean that this recovery already is relatively fragile, and it's still fraught with risks coming in from the virus variants coming in, global risks, and also some of the structural impediments. So there's very little the government can do at this point in time to prop up consumption in a big way. So consumption is going to pick up very slowly. One of the things that the government can do, and it has been in fact doing it in a small manner, is push capex, because it's known that it's a low hanging fruit, especially if they're spending on rural construction works and other infrastructure areas, which is done. And the government seems to not be so focused on extreme fiscal consolidation, and in fact has made some rule for capex. So I think that is one supportive factor. In addition, there are reforms at play, but for instance, the PLI scheme, etc., which over time can bring in more corporate investment. But the point that I'm basically trying to make is that the any kind of direct support to incomes and spending is not really expected to come by, and that could slow down the pace of recovery compared to what we've seen in the previous episodes.
So you spoke a little bit about the inflation in the core sectors also. So this means that the producers will probably pass on the burden of the high inflation to the consumer. Will this affect the economy too?
Yes, in fact, that's already been happening. I
Hmm.
think if you look at the previous episodes when oil price or commodity prices were going on, two things were happening. One is that the government was sharing the burden with the consumers because there were subsidies in place. Second is that the manufacturers were slow to pass on some of these input prices, and they were in a way waiting for demand to come by and have better pricing power. This time, because there's already a squeeze on margins, both government and from the perspective of fiscal position, and manufacturers from the position of the cost that they're placing, it's been the pass on has been pretty significant this time around, and it's expected to continue happening. So to some extent, like I said before, yes, high inflation can to that extent crimp consumption, but the bigger impact, of course, is because of the income dent that's come by.
So how will this affect the revival of the economy? Assuming there's no big third wave, how will this affect the economy,
So I
the
think,
revival?
yeah. So I think two points here broadly. First is that inflation is unlikely to have a direct impact on growth at the moment. Growth is looking for certain other levers. One of which is how the vaccination is progressing, because faster vaccination will in fact enable a number of laggard sectors to start picking up. So far, we've not seen a large part of the services really come back like it has in other economies. So the understanding is that if you look at Q3, Q4 of this fiscal and Q1, Q2 of the next fiscal, we'll see a number of these laggard sectors, most of them being in the services domain,
So what are
see
some
this
of the
one-time lift.
sectors? What are some of the sectors which are not yet fully open? Because governments all over India have started to open the economy almost fully, actually.
Yeah, I think most of them are in the services domain. If you look at entertainment, recreation, one is that because the government is gradually easing restrictions, the other is people themselves are quite uncertain about coming back in terms of opening businesses in a full way because of the uncertainty around variants, viruses, etc. So, our understanding broadly is that for the next 3 to 4 quarters, there will be a one time lift in the economy, which will take say GDP growth to 9.5% this year. Next year would be around 7.5% or so. But once this one time lift effect is gone, then we expect some tapering out of growth and see growth averaging at around 6.5% or so over the following 3 to 4 years.
So now we are in a big question, right? How do we control inflation, or how do we keep inflation kind of low? But at the same time, how do we keep the economy running? How do we grow? How do we become a 7, 8, 9% growing economy?
Right. So I think yes, it's a catch 22 situation. We need to control inflation, but we don't want to hurt the economy and recovery to that extent. And I think RBI has been acknowledging that if you look at the monetary policy, their statement language, etc., what comes forth is that they're ready to be a little tolerant. In fact, they have been a little more tolerant of high inflation than they have been in the past,
Hmm.
keeping in mind the growth imperatives. So, our personal understanding is that if you look at it, two things come up. First is that growth remains a foremost concern because the pickup so far has been gradual, it's been, fraught with risks, it's happening at a much slower pace than desired. And then there are also pockets in the economy which are yet to see sustained revival. We have a financial CRISIL financial conditions index, which overall shows that financial conditions are easy. But when you dig down and look at the various segments, what comes forth is that there are certain segments of the economy where financial conditions haven't been as easy as the rest because of risk aversion, etc. So any moves to suddenly hike rates, etc., can hurt some of these segments. So the RBI is maintaining caution on that front. And the second point being that RBI is also clear about the fact that it's supply side that's actually pushing inflation. And broadly, the RBI from its domain can do very little to control supply side impact on overall inflation.
So should the RBI focus on keeping the interest rates low, or should it try and keep the interest rates lower than it is right now? Will that boost the economy? Is that something viable?
Yeah, no, I think certainly I wouldn't talk about interest rates being lower than now, because they did administer quite a few rate cuts. It's just that the percolation into the economy was not very uniform. So what needs to be happening is that for those benefits to reach the last mile, demand now starts to pick needs to pick needs to start picking up. So there's more certainty, less risk aversion, and again RBI can do little on that front through maneuvering interest rates. So what it's trying to do is manage financial conditions which are relatively comfortable. Our overall understanding is that as growth picks up into Q3 and Q4, the RBI will also start normalizing liquidity infusions, as it has been, taking baby steps in the last couple of months. And towards end of fiscal 2022, they might in fact, announce their first repo rate hike. So that's how we're looking at the.
Should the RBI ask the banks, the nationalized banks, to go and give rates, to look at rates and to lower interest rates? They haven't done it in quite a while. Should they, instead of RBI reducing the rates, shouldn't they ask the banks to pass on the lower interest rates to the people?
Uh, well, I don't think that comes as a very straightforward option. The banks, it's not like the banks are not willing to lend necessarily. It also depends on how much of credit demand there is in the economy. And to reiterate what I said, it depends on appetite, it depends on how risk is being perceived. So, as there is, if at all there is demand for credit, I'm sure banks are more than willing to lend to some of these sectors. There are very little reports that you come across which say that people are out there demanding, but banks are the ones not lending. So that's not happening so far. So I think that part the RBI is not really as worried about.
So there are some external factors too, which are not in the government or the RBI's control. One is the shipping crisis, and the other is the US raising its rates. These are some of the things which not only the government but the RBI is worried about too. Can you tell us some of the pressure points some of the external pressure points for the Indian economy?
Yeah, I think, see, two, three, of course, the shipping and container related trade, but which in my belief, is not a structural issue. It's a short period, concern that is largely because of the global demand being exceedingly higher and coming in at a much faster pace than was expected. So over time, of course, that will get eased. So I don't necessarily look at it as a structural issue that will have an impact. What worries me a little more than some of these is the fact that many of these advanced economies have gone out and infused a lot of fiscal and monetary policy stimulus into the economy. And given the fact that debt levels are high, inflation is picking up, there is going to be a need to start exiting some of these policies. So, broadly, if you look at it, there is some downside to the growth spurt that is visible right now. We also need to be, risks are now a little more tilted, or rather they're shifting away from being pandemic led to exit policies led, and how some of these exits actually impact emerging markets is the foremost concern at the moment.
So, what can happen when the US increases its rates? Uh, Investors in the stock markets will pull money out of the stock markets and invest it in stock markets in India and other emerging economies, and invest it in the US, where it's safer and they'll get higher returns. What are the other things that can happen?
True. I think that that can happen, or rather, in fact, that will happen because typically, when there is any action that's coming in from the US's side in terms of tapering, the amount of stimulus that's gotten pumped in so far, that's going to lead to a lot of jitters. And the number one reaction is that pull out of emerging markets and go towards safe haven. It's just that we need to think about it from the perspective that whether it's going to be as detrimental this time around as it was in 2013. Perhaps no. And I think there are two, three reasons for that. Number one is that, we believe that the US Fed, for instance, is going to be extremely clear in terms of its communication, unlike in 2013, where there was a mention and it led to a turmoil. Second is if you look at the intensity of shock, it's expected to be less sharp in nature because they are beginning with a very mild or they're expected to begin with a very mild tapering of asset purchases from this end of this year, and that's going to continue until mid 2022. In fact, S&P Global has an estimate that even during that period they will in fact be infusing about 1 to 1.5 trillion dollars into the economy. So it's not like liquidity is getting sucked out yet. After that, rates are expected to hike only towards the mid of 2022. So it's going to be extremely gradual. The third thing is that emerging markets, especially if I talk about India, we fear a taper tantrum sort of a situation because last time we saw, our currency depreciate about 14% or 16% against the dollar. We were put into this fragile category. So number one that needs to be seen is how are we on the vulnerability front this time compared to 2013. And I think what's clear is externally, we are in a much better situation now than we were then. It's just that on the domestic front, we are a little more weaker. So, for example, if you look at it from an external perspective, our current account deficit is low. We have an extremely tough forex shield in case of any turmoil that comes by. If you look at, if you compare about six or seven emerging market peers that investors usually look at, we lay somewhere in the middle in terms of our, catch up to pre-pandemic growth level or inflation rate or our debt levels, etc. It's just that domestically the economy is a little weaker, or in fact is weaker after the pandemic now compared to 2013. So investors are going to weigh all of this and then look at it. To end this point, I think one last thing. In 2013, our forex shield was much thinner, import cover was low, etc. Now that's not the situation. So the RBI has the flexibility to in fact go ahead with exchange rate management using its forex shield and then go in towards monetary policy actions in terms of either rate hikes also. So they do have that much of a cushion this time around.
Are there other pressure points that we need to be worried about?
I think inflation and prices certainly, because even if it's a relatively, it's not a long-termish phenomenon. The impact of some of these supply disruptions, shortages of chips, etc., is affecting a lot of sectors. For a country like India, where we were seeing exports do really well last 2 to 3 months, we are also seeing exports see some sort of slowdown because of either the shipping crisis or chip shortage, etc. So I think some of these external risks are also something that we need to keep in mind.
So I'd like to end this conversation by looking at a broader picture. Will India be able to become a 5 trillion economy by 2025, like the government once envisaged?
I think not really. About 2 or 3 years back, we were definitely on a upward sloping curve when we look at growth rate, and that, in addition to inflation and a relatively stable exchange rate, would have helped us get to the 5 trillion mark by 2024 or so. But I think given the hit that's come into the economy in the last 1 year, given the fact that consumption, savings, etc., were already slowing down a little before the pandemic hit us, our ability to grow at around 9% or so in real GDP terms and sustain that growth is limited at this moment. So our overall understanding, like I said, growth is expected to taper off after the one-time lift that we see. So our overall understanding is that a 5 trillion target could ideally get pushed forward by 2 to 3 years.
So, how do we return to the 9%, 8% economy again?
I think In my opinion, the way forward now is via pushing capex, because consumption will pick up, but it may not be the first to pick up this time. So government capex that's been happening should continue, to push growth. The other is we've had a large number of bigger corporates which have deleveraged, and they have the ability to invest. It's just that they're waiting for signs of demand to come by. So some of those can actually be the trigger points in terms of pushing growth. Reforms like PLI, etc., have a good, possibility of pushing growth. In addition to that, GST, etc., have seen 2 to 3 years of initial implementation glitches. It's now stabilizing, so the efficiency gains out of that can come by. So I think a lot has to be done in the sense of giving a big push to the reforms that have already been announced, because one of the most important levers which could have helped us sustain high growth, and that is global growth is also expected to slow in the next 3 to 4 years. So we need to have reforms from within that push and start kicking in. I mean, as I say that, alongside there needs to be a push towards employment, skill development, all of these, which after a period of 5 to 6 years can stand in our face in terms of hurdles.
So, in your opinion, what will be the three reforms that the government has to push for right now?
I think right now the PLI scheme, it's most of these reforms are WIP. The PLI scheme needs to be pushed in a big way. There needs to be impetus for corporate investment to come in the sense that wherever deleveraging has happened. Thirdly, banks are in a good position now to lend. So some continuous push and support such that credit starts picking up should also happen. At the same time, I think certainty in terms of policy needs to be maintained, because that is number one if you'd like corporates to invest. So I think invest anything that pushes investment sustainably over the next 2 to 3 years should pave way for sustained steady growth.
Thank you so much for joining us today, Deepthi.